VATV, Vietnamese American Arizona Television. Hello and welcome to VAATV Real Estate Talk Show with Scott Barlowe and Linh. Investing can be tricky, especially for beginners. However, with the right knowledge and understanding, you can achieve success in your investment. Our talk show is designed to bring out great topics for investors like you. We hope you enjoy the show and welcome to submit any feedback during and after the show. Hello, everyone. Welcome to VAATV Real Estate Talk Show with Mr. Scott Barlowe and Linh. How are you doing?
I'm doing quite well.
Very good. You look very nice today.
Well, thank you.
Okay, so I think today we will discuss a very interesting topic, right? Because investment will be considered a different type, like long-term, short-term, correct?
We'll talk. We'll kind of compare and contrast.
Yes.
The advantages and disadvantages with both, and then talk about some of the ancillary details on both of them at the same time.
Right. Okay, great.
And maybe bring up up to speed a little bit on what's happened in real estate this past week.
Okay, you want to do that first, and then before we get into the topic. Yeah. Okay, what happened?
Well, of course, as everyone knows, the Fed, as was expected, they met and they held rates steady.
Oh,
so we were still right around the 7% range, and that includes both for home buyers as well as investors. So realistically, I don't think a lot of us are holding out an expectation that there's going to be much in the way of rate declines until we actually see what happens with inflation. Inflation just continues to tick up or stay relatively steady.
Okay.
If you think about it, the cost of food, the cost of gasoline, the things that we buy every single day,
right.
Those things are staying much higher than they were a year ago.
Wow.
And as we had talked, the price of gasoline at the pump, it's varied a little bit, but for a number of months it was well below $4. Now gasoline is trending well into the $4.50 range at the pump.
Do you know that the rate for employee increase, the minimum wage is that applied
in California?
Yeah, not here yet.
Not here. No.
Okay. Because with this kind of expand,
that's
quite difficult.
There's a lot of pros and cons in that, and obviously, one of the concerns is what they call a living wage. But by the same token, in many cases, some of those instances where people are getting minimum wage, that's an entry-level job. It's not a career.
Oh, okay.
It's an entry-level job.
Okay.
Some of the career positions, of course, those are paying.
They're very well.
They're paying well.
Well with that.
But even those are not keeping up with the rate of inflation as it stands currently. Some of the big things that fall in for consumers, of course, is we mentioned food, we mentioned fuel expenses, but housing remains doggedly tough to bring that down. And of course, on the one hand, when you raise the interest rate, it drives the cost of housing up. So it's kind of a vicious cycle. If you trying to accommodate things by keeping the interest rate high,
right,
and yet your housing costs are going up because of the interest rates. I'm not entirely sure the motivation or the thought process on how they fix that.
Right.
But nevertheless, price of fuel it remains extremely high, and the cost of transporting goods and services to market remains high because of the cost of fuel.
How do you think about electrical car?
Well, I would say that the American public right now is speaking, and the government, they came out and they wanted to mandate having electric cars much sooner than what the public, I think, is ready for. I'm not entirely certain that the grid is ready for it. If I recall correctly, and I read this last week, Ford Motor Company lost $1.3 billion in the first quarter on electric cars.
Wow.
And they figured that they were taking a loss of about $132,000 per vehicle
Oh, why
And
is that? I thought like that's convenient and more absorbed by consumer.
that's what the idea was going to
Oh,
be.
oh,
But the
mm,
consumers aren't
oh,
buying it.
buying that.
Just not yet.
Mm,
We've artificially shut down a lot of the oil production
mm,
and driven the cost of oil up. We're buying oil right now from
mm.
places like
Nicholas.
Venezuela, which is somebody that is
Mm-hmm,
not looking out for our interests,
mm-hmm. Right,
and of
exactly.
course we're also importing oil from the Middle East,
Right.
and those costs. Those are countries who have their own economics going on, and they
Mm,
don't always have
mm.
our interests the
To
same
help
as
or
theirs.
anything. Yes.
So,
Right.
it seems to me that in some respects, this is an election year, and if
Mm-hmm.
folks are going to want to, make their minds up which way to go,
Exactly. Yeah.
make your mind known at the
Make your
polls.
mind. Yes. So that we can have some difference, like in a good way.
Well, and I think, the other thing too is with
Mm-hmm,
rising fuel costs,
mm-hmm,
you were talking about electric cars, the
mm,
cost of generating
mm.
electricity goes up.
Yeah. Or
And
like something happened, then it's cost more,
yep,
right?
yep.
With the repair.
Yes,
Ah.
absolutely. So,
Uh,
I think on the one hand, it's a
mm-hmm,
great idea,
mm-hmm,
but on the other hand, we can't be the only country doing all of these things,
mm.
especially when China
Yes.
is producing so much with coal.
Right.
The American consumer ends up being the one that pays the biggest penalty, in my opinion.
Mm-hmm.
And so by trying
Wow.
to make some of these policies
Mm-hmm,
happen now,
mm-hmm,
we're actually, I think, kind of tying one hand
mm,
behind our back and putting ourselves at a disadvantage.
mm.
But sort of my opinion, my 2 cents, but
Yes.
clearly the
Mm-hmm.
cost of fuel, the cost of gasoline, the cost of food
Food. Yeah.
are
Mm-hmm,
continuing to have an
mm-hmm.
adverse effect on interest
Yeah.
rates.
Right. Oh well.
The other thing that's
Mm-hmm,
kind of interesting is
mm-hmm.
here in the Phoenix metro area, we've talked a couple of times about affordable housing.
Yes.
And over the last few years, apartment builders have put in numerous apartment complexes
Mm.
and actually generated living space for about 42,000 apartments.
Oh, okay.
Most of those are coming online,
Mm-hmm.
and that had sort of a depressive effect on some of the rent increases,
Mm.
especially in the central corridors,
Mm-hmm.
on the Class A, more or
Mm-hmm.
less the luxury apartments.
Right.
And now, as those are being absorbed, it looks like there was here in this first quarter of the year, we
Mm.
saw about a 0.3% rate of increase as opposed to a decrease. So
Mm.
that's a positive sign for apartment owners.
Mm.
The other thing to consider for apartment owners, especially the big apartment
Right.
owners,
Mm-hmm.
they don't finance the same way that we would do on
Mm-hmm.
duplexes, triplexes, or fourplexes.
Mm.
Remember, we've talked in the past about those that they were
Yes.
financed using
Yeah.
the traditional conventional loans, just like
Or
a
mm-hmm.
house. If you
Mm-hmm.
live there, you could use a VA, you could use a FHA type loan
Mm.
and do your financing. Those are typically 30-year loans.
Mm-hmm.
When you get into some of these big apartment
Right.
complexes, that's a commercial property, that's a commercial loan. And those loans are typically more short-lived, anywhere from 5
Exactly.
to about 8 years.
Yeah.
So
Exactly.
now some of these folks are coming back,
Mm-hmm.
and they're in this time period where these interest rates are higher,
Mm-hmm.
and now they're going to be seeking money to refinance.
Exactly.
And so those costs will rise as well.
Mm.
So we've got some unusual things kind of all coming together here this year. And like I said, with this being an election year,
Mm-hmm.
there's a lot of differences of opinion between the two parties on how we should operate our economy.
Yeah.
And
We have to. Hopefully, the new president gonna think about that and raise up the economy.
well, one would hope, one
Yeah.
would certainly hope.
Yeah.
And then lastly, just an odd bit of news.
Mm-hmm.
Here in the state of Arizona, there was a bill that was presented to the governor's office, and it was to strengthen landlords' abilities to get squatters out of their homes much quicker.
Mm-hmm.
And she vetoed it. She felt like that there were already sufficient protections
Mm-hmm.
through the Arizona Landlord Tenant Act and some of the other existing laws
Right.
that owners were protected.
Mm.
I think that you may end up seeing the legislature go back and try to get something passed yet again this year,
Mm.
especially if we continue to have squatters. But I would say Here in Arizona, we don't have the rash of them that they do in some of the other states, particularly states like California and New York, maybe even Chicago, where they have, by tradition, some very liberal tenant types of protection laws. Here in Arizona, the Arizona Landlord Tenant Act is much more balanced in it, and it does give the landlord some additional protections, in my opinion. So we may see some changes there. So those were some of the things that kind of hit the news here this week. And then I know that you and I had kind of communicated about some subject matter for tonight's discussion.
Right, yeah. So I know like there's a different of the investment, there's long-term and short-term. You can explain to us what is this called long-term, what is this called short-term?
Exactly. Okay. Typically for IRS rules, and you may need to talk with your tax advisor to get good advice on your particular property. But typically speaking, you want to hold a property for 2 years or longer. If you hold it, especially we have people who are flipping apartments or flipping homes, and they come in, they buy a piece of real estate, they spend a lot of money, fix it up, get it ready, put it back on the market. They call themselves investors. I really call them flippers. It's a short-term buy, fix, hold. Now, is that a bad business model? No. For some people, it works very, very well. But if you are truly a real estate investor, and a real estate investor purchases a property with the idea of holding that property long-term and using that property's equity, using that property's income generating, both pay for the property as well as to develop value in the property, and perhaps go on and purchase additional property.
I see.
So that big thing to be most concerned with there is if it's a short-term investment where you're doing a flip, you're truly not getting all the advantages, tax advantages from the IRS of investing in real estate. What you're doing is basically you're selling a commodity. You're creating a job, not necessarily an investment for yourself. So your profit on there is going to be taxed as income as opposed to investment income.
Yeah, because like all the break for the time, right? Like you say, after 2 years, does not apply. So depreciation, let's say, what you
depreciation is one of those aspects. And so, when it comes to different types of properties, remember what we've always said is that an investment property is anything other than your personal residence. So if it could be a vacation rental, an Airbnb, it could be land, it could be apartments, it could be a commercial building, it could be an industrial building. Those are all different types of investment properties. And what you do is by holding them long term, you have the ability to start doing depreciation.
Right.
There's different depreciation schedules, and it's generally broken down into residential, which is typical for apartment buildings and homes that you're renting, as opposed to commercial buildings, industrial buildings, those types of things. Land, of course, does not have any depreciation because land is going to it doesn't have any improvements. It doesn't have any improvements on it. Now, the crazy thing about land is, though, depending on the type of land, you may have some different ways of making income off there. For example, if you have a piece of agricultural land, you could have a farmer that's out here in Queen Creek who's putting in cotton. And he could be growing a crop and in turn paying for leasing that land. On the other hand, you could have a piece of land up on the Mogollon Rim where you've got big ponderosa pine trees, and you could have a lumbering concern that comes in and takes pine trees out. So now both forms have a way of gaining income by selling something that's on the land.
There's one of the audience was asking can you explain the tax advantage of long-term real estate investment, such as depreciation and capital gain and treatment? That's what you're talking right now, right?
Yep, part of it. Part of that's exactly right. So let's go back. I'm going to start off with the short term. Say you buy a house for $100,000. You put $20,000 into it, You've got some other expenses when you sell the house. Let's say those are $10,000. So now you've got a $100,000 house. You spent $30,000 on it. You subtract the $30,000 from that, and those are expenses on it.
Right.
Then when you sell the house, say you sell the house for $20,000 or $120,000, you can subtract your expenses out of there. But because it's short term, you get taxed on all the profit at 100%. Does that make sense?
Yes.
Okay.
Right.
So now let's take a different example. Let's suppose that the most common one is most of us have a personal residence. There is a capital gains allowance for a single person for up to $250,000 in capital gains. For a married couple, $500,000. So let's just say that we buy a house for $350,000 10 years ago.
Yeah.
And you know the way that things have
yes.
But we go ahead and now we've had some improvements on the house, but the market's been very fortunate to us. Now we're selling the house, let's say for $1,350,000. So what we do is we can subtract off of that $1,350,000. We take the $350,000 that we spent when we purchased the home.
Yes.
If we've spent $250,000 to put in a pool add on to it, we subtract that out. And then what we do is we look at how much is left. So once again, if it's a married couple, and so we've got $250,000, $350,000, so that's $600,000 from the $1.3 million. That's $700,000. So from that $700,000, we subtract $500,000. That's the allowance for capital gains for a married couple. So that remaining amount of that $300,000 or that $200,000, excuse me, that's what is subject to capital gains. And generally speaking, it's about 20%. So if you take that $200,000 and you multiply it by 20%, now you're looking at $40,000 is what your capital gains costs are.
Oh, okay.
Whereas if you're selling that house, you pay tax on 100% of that profit. Whereas on this instance, you're only paying tax on 40% or a 40% or a 20% tax on the portion above what your capital gains allowance is.
I see.
So it's especially for more valuable properties where you have higher gains, you end up paying less. And remember, on the first one, as I said, you're not getting the benefits of capital gains or long-term holding. You're paying that as simple income. So if you do 2 or 3 of those a year, you're just whatever profit you make, they're treating it as if you had a job. And so, depending on what tax bracket you're in, you'd be in 28, 36, 37% tax rate on it.
Wow.
So that becomes the advantage. It becomes at least 2 years generally.
2 years,
is generally speaking where you want to have it. And of course, the other thing too is during that 2 years, especially on long-term hold, you can start depreciating things off the property.
Expands on
your,
stuff.
Your roof, your all kinds of things. Now, let's say at the end of a few years, and we go back to that example, we've got a property that we've had for a number of years, and we know that the capital gains on that are going to be pretty significant, but we want to sell it, but we don't want to have to pay all those capital gains. So how do you avoid paying capital gains?
You have to show
One way to do it is what's called a 1031 exchange. In the actual IRS code, and it's code section 1031, which is where it gets the name from, they have an allowance where if you take the capital gains or the profit from that sale of that real estate and you buy another piece of real estate with those profits, you can defer paying taxes on that. So for example, let's suppose that we had that $700,000 in profit, and we wanted to buy another property, except this property was say $3.5 million. So we're going to take that 700,000. We're coming up with 20% down payment. We're buying a new property. So we can roll that whole amount in. Now there's some rules that you have to adhere to, and I'm going to go through just a few of them real quickly. Number one is you cannot touch those proceeds. You have to hire what's called a qualified intermediary. And there are companies here in the Valley and of course across the United States that they serve as qualified intermediaries. Basically what they do is when you sell that property, instead of that money flowing directly to you, it flows up here to another company, and they're a holding company. They're a fiduciary. So they will hold that money for you. And then when you purchase that next property, they will send that money down to the next closing so that it can be used as that down payment. So that's one aspect of it. You must use a qualified intermediary. Second aspect of it is you must identify the property within 45 days. After you sell the first one, you got 45 days to identify the next property that you're going to buy. Now, sometimes investors get into a little bit of anxiousness because they identify one property and it falls out. Maybe somebody comes in and buys it ahead of them. So it's good to keep looking, have several properties in mind as backups. So you've got that 45-day identification period. And then the last thing that you have to keep an eye on time-wise is 180 days from the day you sold your first property to the day you close on that second property. So you've got almost 6 months, 180 days.
6 months, yeah. Which means if something happened to the property you identified, then you always have a choice, right? Second choice, whatever.
Have a secondary choice is exactly
so that
right.
you can close it within the timeline.
So that's a very simplified scenario there, but it kind of gives you the idea that there are ways to go ahead and handle that. Like I said, there's some really high quality companies here in the Valley that can accomplish that qualified intermediary position for you. And then, of course, the other thing, too, is when you do cash out on some of the different commercial properties, at some point you will have to level up with the government as far as on depreciation. But, you know, the beauty of it is you're getting to keep that money in your pocket for a longer period of time.
Yes.
So, the present value of money in your pocket has a much higher effect than it is down the road.
Oh, I see. So basically, really, long term is more advantage.
Well, it is, and some of the disadvantages of short term, like I said, it's not really investing. What you're doing is you're doing sales. You're
buy sell, but it's not like investing, because like whatever the money that you make there, you gotta pay the tax, but that kind of tax doesn't get the break from the benefit of the tax law.
It's treated more as regular income,
a regular income.
It's basically you're buying yourself a job.
Well, depend on people's situation. Sometimes they only use that. They only they have no income or anything.
Well, and you know what? You're exactly right. I'm not saying that's not a good way to do it for some folks. And certainly I've had clients that wanted me to locate properties for them where they could fix and flip them. And it's a good strategy. But you just need to bear in mind that it's not truly investing. You're creating an income flow. But your income flow is created by the purchase, fix up, and sale.
Oh.
And generally, in many of those cases, they're occurring within the same calendar year.
Oh, yeah. I heard of many people do lift sale, buy property and do all that. They make money.
So they don't get all the advantages of long-term investing.
Instead, they can hold it for 1-2 years, like you say, after 2 years, right?
Generally after 2 years, but like I said, you'll want to talk to your tax advisor to make sure that it fits your circumstances.
Yeah, exactly. Okay. And then you say you already explained the how about the building equity that
that's one of the nice things here. Historically speaking, since the year 2000, if you look at real estate values here in Arizona, yes, we've had some ups, we've had some downs. When the Great Recession hit, we lost a lot of value in property, and there were a lot of people that bought foreclosures for extremely low amounts. In fact, I have to laugh. I've got one client. He bought a house in Santan Valley for $72,000.
Oh.
And he bought it. Fortunately, he bought it. He's using it as a second home. He does rent it out short term for friends and stuff. But the biggest thing was he wanted a second home so he could come down and play golf and things, because he's lived in one of the northern states.
Oh.
That same home is worth $460,000 now.
Wow. Oh.
So
boy.
just imagine the capital gains that he would pay.
Wow.
So he's going to hold on to that for a bit longer. But nevertheless, my point on this is, if you look at what's happened here in the Phoenix metro area, over time, our values have gone up. So that for him, that $460,000, he subtracts the $72,000 plus if he's any other improvements that he's done on the house.
Yeah.
That is all profit. That is all profit. He has nearly $390,000 in profit over 14 years.
Oh, wow.
And that's just long-term hold. He's using the house for vacation. So he's getting value of his own out of it.
Yeah.
But imagine that if you bought a house right after the Great Recession and you were still in it, your house would probably have doubled, tripled, or maybe even quadrupled in value. So that's an advantage of long-term investments, and that's the advantage of appreciation. Here in the Phoenix metro area, we may see a flattening of values this year, but long-term, year in, year out, over time, it seems like we appreciated about 4.5%.
Wow.
So it's good, steady
What
growth.
you just said is like the same question that people raise up, like they want, can you share example of successful long-term real estate investment portfolio you have helped client build? So those are, just explained that already.
Yes.
Yeah, for that.
Who is it? I know that there's an author out there, and he talks about grow rich slowly. That's one of the things. In the past, we've talked about risk and risk management when it comes to investing. Of course, bonds, annuities, those types of things, those have very little risk. But generally speaking, unless we get into times where, just like now, where we've got inflation going on and they can raise the rates for return. But generally speaking, for years, during the times when we were getting interest rates at 3.5% on mortgages, those annuities and bonds were down in the 1.5%. Now, certainly there's always some exceptions, but nevertheless, much lower. But the key thing there is extremely safe. You know it's going to pay off every month. You know what the amount is going to be. You don't have to worry about things. On the other end of the spectrum, where the most gains were possible, was in the stock market. And not with all companies. Certainly some companies like Berkshire Hathaway. I use Berkshire Hathaway because Warren Buffett is familiar to most investors. And he and Charlie Munger have had an excellent reputation as far as developing value. But their companies have held value, appreciated in value for years and years and years, but not to the same rate that you would have in some of our real estate. Like go back to this gentleman that I was telling you. He bought a house for $72,000, and now he's almost quadrupled in value. So that a 400% increase over about 14 years. You can't find that with some of the stocks. I mean, it's highly unusual that you find it with real estate, but the key thing there is there are opportunities. We are in a metro area that is going to continue to grow for a long time. When I grew up, I was raised in the Detroit area, and certainly I saw what happened in the Midwest, the fluctuations with jobs, the fluctuations with the automobile industry, and I could not, in good conscience, say, go back to Detroit and buy a house. I just don't know where the value is going to come, where the appreciation is. But yet out here, we're in one of those time periods where our economy is still expanding, despite the fact that interest rates are at 7%. Our economy is still expanding. You know, I live down in the Santan Valley, Queen Creek area, and you know, one of the things that I see when I drive through there is LG is building their battery plant. They've got an investment of 5.3 billion, excuse me, with a B, and they've already begun. They broke ground. They have steel up, so the factory they expect to have completed by 2026, and probably bring in 3,500 employees.
Wow.
That's a battery plant, and it's for EV cars.
Yeah, right.
You know, over on the northwest side of Phoenix, Taiwan Semiconductor, they are building a huge campus over there.
Yeah.
And, you know, I know that they're adding additional acreage to that. So not only are they building a plant to produce semiconductors, they're also building around there housing for employees.
Yeah.
So everywhere you look, we seem to have growth going on.
Wow.
And I know that.
And then commercial, and then the store and retail,
Absolutely,
all
absolutely.
that come in. Yeah.
The toughest thing right now, as we have said, is primarily on the housing market. Homes are kind of a little tougher because many of those beginning market entry folks are not seeing the opportunities that they did 3, 4, 5 years ago. The values are lower. The cost of the homes has not come down. When the interest rates went up, the price of the homes didn't come down. They continued to rise. And so if you look at the price of a single family home now, it's actually about 3% higher than it was last year.
Yes.
So, and that's in addition to those higher interest rates. So it is squeezing those buyers, and it is kind of slowing things. But nevertheless, you know, as we mentioned just a minute ago, even with apartments, there's a lot of apartment doors that are opening up that have just been built and are coming onto the market for the first time. And so renters are getting some relief as well.
It's a good idea to buy an old house with lower price than a new house, like brand new house with a little bit of higher price.
Well, it depends on your skill set.
Okay.
I mean, you know, I would say in my younger years, because I had a little bit of a construction background.
Yes.
When I went to college, I worked doing housing construction, and I've had a lot of family that was familiar with doing electrical, plumbing, those types of things. So for that type of person, sometimes it's easier to get an older home and refurbish it. Your entry into an older home, especially if it's a little bit cheaper, is usually a little bit less.
But I mean, like, yeah, if you know that, because the price for the material.
Yes, and over time, of course, then you can build it up, build the value of the home the way that you want. Whereas if you don't have those skill sets, in many cases, you need a finished product, and you need to get the best possible price that you can get on it. Right now, I would say that actual home builders have got some good things going on, and as we had talked about a couple of weeks ago, they can do things because they have their own funding sources out there. They can do the 2-1 buy downs, where they can do a temporary reduction of your interest rate for a couple of years, with the idea being that hopefully that, you know, say you buy a house now, in a year or two, hopefully interest rates will come down. Now you got to go back out and refinance it to bring it down.
Wow.
But you've got the advantage of the advantage of a new home, and that new home has a warranty on it.
Okay. Like, not worry about a repair or like all bad things, roofing or any internal things that occur.
And that's why I say, if you're somebody that doing repairs on your home doesn't bother you, that you can do, I have to emphasize, in a skilled manner. There are people that I have seen that have done repairs on their homes. Very shoddy, very shoddy. They were better off not doing anything than some of the repairs that they did. And certainly when it comes to electrical, HVAC, and plumbing, you need to have a licensed contractor take care of those. any one of those can destroy a house if it's done improperly.
Exactly. Yes. Yes. Those are very important.
You know,
Like,
if you don't have a licensed painter, it's not quite as bad.
yes, right. But we talk about the structurized, like
The structural
yeah,
things,
yeah.
yes.
The
The mechanical,
plumbing,
the
the
mechanical
electrical,
things,
mechanical, yeah,
yes,
all that.
absolutely.
Wow. So those really, and then like what about the property that we require like management to look over and keep the income steady? And
Yes.
then yeah,
Well, there's two things.
yeah,
You know, my philosophy is this. If you're going to be a landlord,
yeah.
you need to get eyes on your property at least once a month
Mm.
or more often. Even if all you do is you just drive
Drive
by
by.
and
Yes.
look at it.
Right.
I had the unfortunate experience. I had some clients. They were from California.
Mm-hmm.
They bought some apartment buildings,
Right.
and they had them for 15 years. Had the same apartment manager. Had them for 15 years. Never once did they come to Arizona to look at them.
Mm.
When it came time to sell it, and I went out and I looked at them,
Mm.
the condition of the buildings was such that they were on the poor side.
Wow.
And you know what it did is it created some hard feelings because their property manager, quite frankly, had not kept up with things.
Mm.
A property manager should look out for your property, look for
Exactly.
ways of building value in your
Right.
property, not just put somebody in there.
Right.
And unfortunately, the buildings were worn out.
Mm-hmm.
So when it came time to sell them,
Mm-hmm.
we literally sold them at a discount because
Of those, yeah.
of those.
Yeah.
Now, did they get appreciation? They bought them for a couple of $100,000.
Mm.
They held them for 15 years.
Mm.
We sold them for well over $500,000. So yes, but if they had been cared for as they should have been, they should have sold for well over $600,000 at the time. So that's one way where a property manager can hurt you. And that's why I say you should always go get eyes on your building. I know a lot of a lot of owners who do their own property management.
Mm-hmm.
And of course, that gives them the greatest degree of control.
Right.
As we always say, nobody cares about your money as much as you do.
Right.
So if you're managing your property, you have a bona fide interest in that property. And you're going to be making the best decisions for yourself,
right,
as well as for that property.
Mm-hmm.
Now, the property, having a property manager always has an expense cost. And I know that my brokerage, S.J. Fowler Real Estate, that we do property management. I believe that we have over 600. I know we've had as many as 900 properties that we've managed on a monthly basis. But we do charge for that. I mean, it's anywhere, depending on the type of property,
right,
anywhere from 6 to 9 or 10% a month to manage that property.
Right.
And it depends on the there's different levels because there's different amounts of management expertise that has to go into it.
Yes.
Some are complete service where they take care of everything from A to Z. Others, there are things where the owners will take care of things. So that's why there's that variation. But nevertheless, that's still an expense. That's an expense that you have to pay to keep your property going.
Right, exactly.
So, if you can do it yourself, if you're small enough, if you're, and I've had, I had another client, helped him buy and sell 6 or 7 different apartment buildings. And he was a tile contractor. Did excellent work. And as time went on, he acquired more and more apartments. And then he just stopped working. He stopped doing the tile work, and his sole job was managing his apartments.
Oh, okay.
So remember that 8 to 10%? He was making that 8 to 10%, and it was going in his pockets every month.
Wow.
He was paying himself to take care of his own property.
Wow.
So once again, here's a guy who's got the skill level where he can go ahead and take care of repairs and those types of things, and at the same time manage his properties. So that he reduced that expense.
Yeah.
But by the same token, let's face it, we were talking earlier about all these units apartment units are coming
Yeah.
onto the market.
Mhm.
Well, some of those complexes are 200, 300, 600 unit apartment complexes.
Mm.
There's no way that you have an individual owner in there,
That's true.
much less that individual owner can manage his own property.
Exactly.
So in many cases, what you do is you do have to buy or hire a full-time property
Full-time
management.
property manager. Yeah. Like an office or
Yep.
something. Or I think like sometimes like that, they have like an association, the office, who can do that, or others.
I've seen
Yeah.
all kinds of different models for how
Yeah.
they go about doing it.
Uh,
I've seen it where some of the major apartment owning companies,
yeah.
they have their own property manager as a sub business to the overall management.
Look over that. Oh.
Yes.
Wow. So is so best like not. I mean, like a lot of people mention about investing on some of the property like out far away. You know, like not in the same your state, different state. Then that's gonna be hard.
My experience is if you've got a small property like that and it's out of state, and I can give you horror stories. I had some other folks that they owned some apartments in Idaho, and in theory it was a great idea, but once again, because it might be a year or 2 years before they go see those apartments. It's the old story: when the cat's away, the mice will play. You don't know what kind of care that property is receiving on a daily basis by your property manager. And so when they went up there, they were appalled at the condition of their property. Now, that's not to say that there aren't a lot of really good property managers who take a great deal of pride.
Right.
But nobody cares about your money as much as you do.
Yeah.
So you need to go investigate. You need to go take a look at what your property is, how it's performing. Even if it's in Idaho, hey, in the summertime, that can be a nice place to get out of the heat.
Exactly.
Drive up and go take a look. But you can't expect it to be long term, far away, out of sight, and it's going to be fine. If that's the type of investing that you want to do, there's other ways where you can invest in real estate to do that. A REIT is one of them, which is a real estate investment trust. And that's a company that brings investors together.
Right.
And they buy a property. They actively manage that property, and then they distribute the property to the investors that are part of that REIT. And there's a couple of excellent REITs here in the Phoenix area.
Yes.
There's one that I think pretty highly of. It's over off US 60 and Val Vista, and it's in a really nice shopping center. That is a REIT, and they have several shopping centers here in the Valley, as well as a number in Texas and some other states. They have very high functioning property management. They do a great job on planning and adding value to the property for caring for it. They do additions, they do remodeling, all types of things. So my thought is, if you want to be one of those folks who wants to be relatively passive, there are opportunities and there are ways where you can get
invest in using the company to, like a good company for that area. You mean for that state, right?
Yep.
Yeah, who's gonna take care of all that and be responsible with the group.
Yes, invest with them, because they're also looking out for their own interests.
Yeah, that's a good idea. Yeah, that's another scenario, right?
But like I said, if you're a small investor and you've got a house or you've got a duplex or even a fourplex, you need to, and it's a ways out of your residential area. You can't drive to it conveniently.
Right.
You're going to have to rely on a property manager. There's no way
you can do
that. You can handle the property management yourself.
Right.
And so if you do that, you need to make a point of at least once a month taking a look at your property. Go look at it, drive by, see what it looks like. I own a duplex in Gold Canyon, and I drive by there probably once every 10 days.
Oh boy, yeah.
So I mean, and I'm constantly taking a look, and I can, for example, when it rained early in the spring, and I saw how the weeds were starting to come up,
what happened.
I immediately got a
that's a rental or
yes.
Oh,
So
like somebody there.
I've got 2 units for rent there, And so I immediately got a company to come out and spray for weeds so that we don't have any more weed issues.
Yeah.
And I pay for the landscaping, and those types of things. On the other hand, I saw a tenant that was parking a vehicle in an area where they shouldn't, so I gave them a warning. Now, those types of things I never would have known had I not gone out there. And while I'm talking about that,
will they follow? That's the thing. Like you give a warning, but what if it happens again?
Well, if it happens
when you're not there,
if it happens again, see, they don't know when I'm coming by. So if it happens again,
they evict it.
I can evict them. I had a tenant that he had a septic system on his apartments, and he had tenants that wanted to park where the leach field was. And it happened several times. He had to pay to have the leach lines repaired and everything.
Wow.
He lived in Michigan. He asked me to go take a look at it a couple of times. So I drove by, and I said, they aren't going to listen to you. What you need to do is this. And what I suggested to him, gave him the name of a company that could bring landscaping rocks out. So they bought big rocks out and blocked it so that they couldn't drive up there. There's always a way.
That's true.
But the one-time expense of putting those big decorative rocks out there was far less than it was repeatedly having somebody with a backhoe come out, dig those lines up, replace them, cover them again.
Oh boy, yeah. So many situations there.
But once again, it's a matter of you got to have eyes on your property. You need to know what's going on.
Yeah.
And in this day and age, everybody's got a cell phone.
Yeah.
And you can take video, you can take pictures. One thing I might mention is if you aren't able to get to your property quickly, and you do have a property manager, there's no reason why they can't drive by your property once or twice a month and send you videos of it.
Right, that's true.
So I mean that can be a substitute, but in the end, you still need to make a point of getting to your property and taking a look at it.
Yeah, it's a good idea. Or depend on the type of property. Outside, you can put like a camera for your own.
You can
review, right?
You can do that.
Yeah, depend on that. So so then is the bottom line is like we support, really there's a lot of benefit for long-term investment, and the type of investment that you have to think you can manage it or find a good manager. Right.
And remember too, if you're holding a property for years and the value of that property is going up, those fees that you pay for property management, you can deduct them from the cost of, that's a
get
cost
more
of
depreciation, more inflation in
a good property manager will make you money, and a poor property manager will cost you money.
Yeah, cost money and or nothing.
Yep.
For that. So so that was really good. And then you think like a lot of people was asking like, is that a good idea to do diversified portfolio?
Well, I like the idea of doing different things, and this is just kind of what my observations. I've been doing this for 18 years. My observation is that we usually start with what we understand.
Right.
And so what do most of us have the greatest familiarity with? With a house.
Yeah.
We typically live in a house. We have our own single family home that we live in, or we may have a duplex or something like that. But we start in our own living situation.
Right.
Where we understand,
understand how it works. Yeah.
Exactly. So we understand how that works. We begin to understand how residential financing works.
Yeah.
So usually what I've seen is that you'll start having folks who get single family homes. Maybe they get several single family homes, but remember, what's one of the advantages of having a multifamily? Single family, if it's vacant, you got 100% vacancy.
Right.
In my case, I've got a duplex.
Yeah.
If one of the units is vacant, I got a 50% vacancy. So now I've still got cash flow, even though I don't have a tenant in there. The more doors you have, the lower it lowers your vacancy rate, and you still have cash flow coming. So that's one reason why single family people will start off at single family homes, but as quick as they can, they start looking at multifamily.
Mm.
The more doors that you can get,
Mm-hmm.
I use the term doors, but the more apartments that you have,
Mm-hmm.
that's more streams of rental income each month coming in.
Mm.
Now, the other thing that I have seen is that people, especially if they're self-managing, one of the things that they don't particularly care for is that you have to constantly stay up on your leases, because with a residential property, the leases are 1 year in length, typically. So every year you're looking at renewing leases, and you may be renewing, if you've got several properties, you may be looking at renewing leases every month. And for some folks, they're not so crazy about that.
Right.
So then they start looking at some of the more commercial properties, whether it be an industrial property, whether it be a strip center, whether it be an office building, something where they have tenants who typically want to be there longer. A lot of times on a commercial building, you'll have tenants that want anywhere from a 3 to a 5 or a 7-year lease. And if you've got, depending on the type of property, you may have somebody that's in there on a 20-year lease. But you can build your rent increases in there. And the sophistication with dealing with those leases is a little bit higher. But once you get that tenant in there, you're passing your expenses off to that tenant. Whereas with a residential property, hopefully your rent is covering your expenses. For example, if you've got a mortgage, or you've got insurance, or certainly your property taxes, you want your rental income to be able to cover all of those things. But on some of the commercial properties, depending on the type of lease that you use, you can offset those costs directly to that tenant. In addition to their per square foot price for renting the property, you can do what's called a triple net, where insurance, taxes, as well as maintenance on the property, they get distributed and prorated out to the various tenants based on how much space they occupy. So that becomes another way of doing it. And in those instances, the value of the property can continue to rise. You can bring in good quality tenants, and you already have your rent increases pre-programmed into your leases. So if you've got a 5, 6, or 7-year lease, the first year maybe at a set price, the second year you have a 3% increase, the third year another 3% increase, and so on during the life of that lease.
Yeah, that's a good idea.
And so those amounts are already known. The sophistication that you have to have does go up. The lending requirements do go up when it comes to purchasing those types of properties. We'd already talked a little bit about purchasing a single family home, a duplex, a threeplex, or a fourplex, that you can use residential financing. So if you're saying you were living in one of the units of a fourplex, you could theoretically use FHA financing and get in for as little as 3% down, or VA, for basically nothing down. Live in there for a couple of years, rent that last space out, and then you can still just continue to make your payments. So your entry into those types of property generally is less expensive than it is on commercial properties.
So at least they stay in there.
Yes.
They claim how long you say? 1 year?
2 years.
2 years.
2 years.
They say they can, after they can still continue making the loan.
Correct. Correct.
Okay.
Whereas
at that time the interest rate is good, right?
Yes. If you go back to the commercial property, so when you want to buy a commercial property, usually you're looking at having to put down 20 or 25% down. So remember we were talking about that property we were doing 1031 exchange on?
Yes.
We had $700,000 in cash. At 20% for our entry, our down payment, that could get us into something as high as $3.5 million.
Okay.
On the other hand, if we could only put if that 700,000, depending on the type of property, we were only allowed to put, or we needed to put down 25%. That would be 2.8 million that we could qualify for.
Oh, okay.
So you need to pay attention to what the property type is. The other thing too is, in many cases, the lenders are going to look at what your experience is. If you're a first-time investor and you're wanting to buy that $3.5 million property, you're probably not going to get into it for 20% down. They're going to want to see that you've got some qualifications,
Right.
you've got some experience, you've got some knowledge, you've got somebody to help you with managing the property.
Yeah.
And they may put some other conditions on you. In addition to your $700,000, they may want an additional amount that you're holding in the bank as a reserve.
That's true. Yeah. Beside the down payment.
Beside the down payment.
Right.
So those factors, like I said, entry into residential is usually where everybody starts because the barriers or the hurdles to get in are usually lower. When you get into the commercial side, the hurdles are higher, but you can have much longer term values, easier for property management. You don't have that annual lease aspect as well, and you can pass on expenses directly to your clients or to your tenants. Excuse me.
Wow, great talk. Yeah, I think like with all that information, we kind of know our situation, and we have to think very clear before we do the investment. Put down the money, and then was thinking like we can get some money, or for tax strategy and all that.
Yes.
Right. Yeah. Very good, Scott. I think like it's time's up now, and I know a lot of people will we really want to hear more on some of the information here. I know it's more scenario, more example that you can bring out.
Absolutely.
So then we can save that for the next week.
Yes.
And then we can explain more to the audience.
And if anybody has any questions,
yeah,
you've got my phone number there. I know my email address pops up.
Yes.
Call me, text me, get hold of Lynn V.
Yes.
Happy to answer any of your questions.
Right.
And,
yeah,
the biggest thing is nobody cares about your money as much as you do. You need to understand how this works so that you can be a good, safe investor.
Okay. Thank you so much, everyone, watching the Real Estate Show from VATV. And we will see you next week. And have a great week. Thank you.
Bye-bye.
Xin cảm ơn sự theo dõi của tất cả quý vị trong những giây phút vừa qua. Chương trình VATV xin kính chào, tạm biệt và xin hẹn gặp lại quý vị vào lần phát hình kỳ tới. Mọi chi tiết về thông tin thương mại và bảo trợ, xin mời quý vị hãy liên lạc về địa chỉ email vaatelevision@gmail.com và số điện thoại là 480 289 9816 480 289 9816, website vaatv.com và vaaznews.com. Xin kính chào, tạm biệt.